Hello and welcome back to the Property Investors Handbook Podcast. I'm your host, Adam Bell, and today we're diving into an essential topic for all property investors, understanding what the Australian Taxation Office, the ATO, looks for in investment properties, particularly focusing on their advanced data matching capabilities that they've now got. Joining me again today is Tony Sutherland, who is a seasoned accountant who will help us navigate through the ATO's scrutiny and ensure compliance. Let's get started and ensure our investments are not only profitable, but also perfectly aligned with tax regulations. Tony, welcome to the podcast.
Thanks, Adam. Thanks for having me again.
No problems at all. Good to have you back. All right. Well, look, let's start off with, what the ATO might be looking for in terms of discrepancies when it comes to investment properties and tax returns.
Okay, as we've probably mentioned before, residential rental properties in particular are always high on the ATO's annual target list. So they're always looking for, they have an opinion that, not everyone's doing the right thing. So they're looking for discrepancies. At the top of the line is, is everyone reporting all of their rental income in the first place?
Yep.
Some people get it in cash, some get it through agents, things like that. So they're looking at all the areas that they can identify that there might be underreporting of the income.
Sure.
Then on the bottom lines, they're always looking for overclaiming of expenses.
Okay.
So
the two classics.
Yeah, they're the two classics. So they're looking at all those areas, and there's a couple of particular things around expenses which we may touch on a bit more. But things like where travel expenses, people particularly from interstate used to claim travel expenses to visit their rental properties, and
so that now no longer can be done. Is that right?
No, that's all been changed a couple of years ago. So you can't do that anymore. So they're looking for people still doing those sorts of things, yeah.
Right, okay. Well, look, while we're on it, what are some of the other ones that they do look for, particularly in claiming expenses that you just shouldn't or can't do anymore?
Yeah, the biggest one they always look for is a red flag is repairs and maintenance.
Right.
Okay, if they perceive that the repairs and maintenance costs for that particular year is excessive, they'll probably delve a little bit deeper into it. And that's particularly when someone's owned the property for the very first time, in the first 12 months.
Okay.
The ATO have a guidelines where their rulings are that if you buy a property and you have large repairs and maintenance in the first 12 months, they deem that to be capital expenses on the basis that you bought the property cheaper because it needed all this repair work.
Right, so
that's their theory, but yeah.
Really good thing to understand that probably a lot of people don't realise. So
yes,
first year and what you do in that first year is obviously well and truly on their radar, more so than probably subsequent years by what you're saying.
Yeah, it is. Yep. Yeah, first 12 months is crucial for repairs and maintenance. So landlords, owners need to keep that in mind and try and keep it to a minimum
during that period.
If it needs repairs, general repairs after that, it's not going to be on their radar as much.
Nearly as much.
I can give you an example of a client in Sydney some years ago. He bought a property and then within a matter of months discovered, it was never disclosed, but it was discovered it had a major plumbing water leak under the slab.
Oh, really?
Yeah. So it cost him, tens of thousands of dollars, and the tax office denied him a deduction for repairs, even though he didn't know about it. There wasn't a price adjustment when he bought the place, things like that. And we argued till we were, blue in the face, but they weren't, unless we really pushed it through the court, they weren't going to relent on that one.
Do you think that could have been different had it been beyond the first 12 months?
Yeah, certainly. Yeah. Yep. So it wouldn't have been as big a argument, between the owner and the ATO and us, if it had been further down the track.
Sure, yeah. Sure. And look, probably a good point to make while we're on the topic of, whether looking at the rental income and expenses, whether you're claiming things that you shouldn't, that's a great point for me to make, that this is where a property manager and has all of the records and absolutely everything to back up, what you are putting in your return. But if you are your own, managing your own property, you've got to be on top of those records, don't you?
You do. You certainly do. Because once the ATO start looking at it for any reason, you have to have the records to justify your position that you've taken in your tax return or your subsequent, arguments with them.
Sure.
So, it's definitely record keeping is crucial.
Yep.
Yeah. So
excellent. Well, look, one thing I do want to really delve into with you today is the data matching capabilities that the ATO now have. Because, look, we're living in a different world now with technology that is available, AI and such, but data matching sort of on the same level. Look, years ago, they didn't have the ability to be able to look at various different sets of data and link them together in order to, put a picture together, but they can now. Can you explain what they can do and how they can do it?
Yeah, okay. Like everyone, the ATO's capabilities for data matching through technology is growing. They're investing a lot of money into those areas because it's very fruitful for them. Yep. So they're gathering data from all sorts of places. Obviously they get it from all the state titles offices.
Yep.
Where they're looking at who owns what property. Is it their residential main residence or is it a investment property?
Yep. And
then they're matching it against returns to see if there's income being declared. There's data matching from places like the RTAs, state RTAs, the residential tenancy authorities.
Yep.
As property managers might mention, they have to declare what the weekly rental is on those properties.
Yep.
So the ATO is getting data from those. They're getting from the land tax offices, all of those government areas in particular. They're not getting it generally from private organisations like property managers at the moment.
Yep.
But the day may come.
Sure. Here's a question for you, because I'm I guess what you'd call your lay person when it comes to all of this, and do my tax returns online, and they've got the pre-data that they've already got in there, your group tax, etc. And they do get your interest from your bank account. Do they have access to your bank accounts?
Absolutely.
Yep.
Yes.
So 100% of the data in your bank account, the ATO can look at any time.
Yeah, exactly.
Yep.
Yeah. So the banks are required to report things like people's yearly bank account interests, term deposits, even now share transactions that are listed on the stock exchange are going onto your pre-fill reports. So, but if the ATO wants, they'll have access to your bank statements, and they can trawl through that 12 months, however many years they like, and seeing what deposits are going in there, and then you get the tap on the shoulder saying, please explain.
Look, I think, and this will be an episode for another day, but what they'll be able to do with AI in the future in terms of not even to having to trawl through it themselves, but to get AI to look through and flag. Look, probably starting already, I would imagine.
They've already done that. They have document recognition, so they can key in parameters that they're looking for, and the computers will do it for them.
Yep, sure. So how can property investors ensure that their data is accurate and compliant with the ATO?
Yeah, it gets back to that record keeping. So, for example, the best example is where if you've engaged a good property manager, they're going to have a full record of all the rents collected and all the outgoings that they've done for you. For example, a good property manager will even pay your rates and body corporate costs and things like that, if you like. And then that appears on their annual statement summary for you.
Yep.
And then it's only up to the owner to keep sort of incidental expenses they may have paid directly themselves.
Sure.
So dealing through a property manager is a good thing because it sort of consolidates most of the information you need, and then there'll be some other data you may need to keep yourself.
Sure. Okay. Now, here's a question that I'm glad that I'm asking you as an accountant, because you would have had to deal with this with some of your clients, I'm sure. How does one prepare when they do get the tap on the shoulder and there's the email, we're coming to give you an audit? Whether that just be over your investment property, or obviously when they're doing it, it's across all your tax affairs. But
yes,
what does one do when they get that tap on the shoulder? How do they prepare?
obviously the best thing is to go see your accountant.
Of course,
straight
and
up.
a good one. I know one for anyone listening.
Yeah, it's definitely wise to go see your accountant because you have time limits that you've got to reply to the ATO in.
Yep.
And their audits or their reviews can come in different forms. For things like rental properties and things like that, it'll generally be just correspondence.
Sure.
So it'll be letters, emails, maybe the odd phone calls where they'll send you a letter requesting certain information that you'll need to supply to them if they're looking at particular issues. It could, if you had multiple rental properties, it could get to what they call a desk audit, where they come visit you and drag out all your records. That's pretty unusual, unless they think it's something.
So that doesn't happen, because that's the vision most people have, isn't it? That the accountant with the straight-looking audit guy with the black tie and the black suit turns up and sits at your kitchen table and starts shifting through everything. Yeah,
that used to happen a lot, but technology's prevented a lot of that. So it's correspondence, generally via email and phone and things like that. Yeah.
And how deep do they go when this actually happens? I've never been audited. Hopefully, never. Not because there's a problem, just because of the hassle. I think. But how deep do they go?
Look, that again depends on how serious they perceive the problem to be.
Right.
It can be very basic. It might just say, we think your repairs and maintenance costs are high this year. We want a breakdown of those repairs and maintenance, and please explain, sort of thing. And there might be some back and forth as to, why did you need to repair that kitchen or that bathroom or, the roof or whatever. So and if they're satisfied, that might be the end of it. But if they still see there's a problem, they'll go a little further. If they find someone who's been really rorting the system, not declaring
really gone to town
income, that sort of stuff. They can go back 4 years and deep dive into.
Okay, so 4 years is it? I thought did it used to be 7?
No, it used to be 7 that you had to keep your records from the date of time of lodgement.
Right.
That got reduced to 5 years. That's record keeping.
Sure.
But generally, the ATO can only go back 4 years in tax returns if they believe there's an error or some sort of simple, straightforward thing.
Yep.
If it's fraud, they can go back as far as they like.
Right. Okay.
Right.
So if
it's interpretation of the law or things like that,
if you've done things deliberately rather than just miss,
But if it's like that, it's 4 years. They can go back if they want.
Fantastic. Well, look, some absolutely invaluable advice that you've given there, Tony. I really appreciate your time today. I think the key takeaway probably for listeners here today is, look, stay informed, which will help you stay compliant. And the key is really the key to managing your investment properly successfully, and get advice from, people like accountants and so forth.
Yes.
So, look, don't hesitate to reach out for personalised guidance on managing your property portfolio within the scope of the law. Please visit Colleen and her team and get information that you need from her website, which is spmg.com.au. So, look, join us next time on the Property Investors Handbook Podcast for more expert tips on maximising your property for investment success. And look, thanks again for joining us in the studio, Tony.
Thanks for having me, Adam.